Thanks, Chris. Good morning, everybody. I'd just like to start by thanking you for taking the time to join us this morning, and also for your support over the past year. As Chris said, I stepped up to the role of Finance Director earlier this year in August. I've been with the group for about just over 7 years. In the last 5 years, I've been Group Financial Controller. And as you'll see, it's been quite a busy first few months for me in the new role. If we just start off by looking at our group performance, as you can see, and as Matt said on the video, we've had a really strong performance again this year. Our group turnover has increased from 660 million to 795 million, an increase of around about 29%. And our profit before tax has increased from 43.7 to 119.7 million. That's overall an increase of 76 million pounds. What we had last year is, as well as a strong underlying performance and increase in profitability, we also saw Derwent join the group. Derwent Housing joined in December 16. So we saw 3 months of their results consolidated into our group position. But also we had a 41 million pound profit in relation to the negative goodwill as they joined the group. You can see there that our operating margin has stayed fairly consistent at around about 20%, with our reserves increasing and also our asset base increasing. As well as a really strong financial group performance, we've also had some strong operational performances as well. And as Pat mentioned in the video, we've had some challenges around welfare reform. And I think what I wanted to demonstrate here was our strong commitment and our proactive approach to how we deal with the risks to the business. So the first one is looking at our social housing letting operating margin. And you can see there that that's remained fairly consistent over the years. We did have the first year of the 1% rent reduction that came in from the 1st of April 2016, and that is to continue until March 2020. The government have announced now that that's going to increase from the 1st of April 2020 back to CPI plus 1. But what we did was back in 2015-16 was we took the approach to drive forward efficiencies. And as a result of that, we've been able to keep our margin at around about the 40% mark, and we're committed to keep that margin at 40% during the course of the rent reduction and over the next 3 years. Also, just to highlight there in terms of current tenant arrears, again, what was mentioned in the video around universal credit, that was announced back in 2013. And what we did was we immediately took action to try and reduce our current tenant arrears. That was working with our customers and excellent work from Pat's team in order to engage with our tenants and make sure that they're paying all their rents on time. What we have seen now is a reduction over the years, and we're currently at 2.2% in terms of our current tenant arrears. And that is outperforming the sector, where we've got an average of around about 4.5%. Moving on to our latest numbers. These are our interim figures up until the half year to September 17. As you can see, the turnover has reduced slightly, but we've got an increase in profit before tax of 23%, and we've also got an increase in our group margin of 4.4%. What we have seen in the first part of this year is a reduction in the development for sales activity in comparison to the first half of last year. But our increase in profitability is driven through the introduction of Derwent for this year compared to last year, and also our drive to reduce costs in order to increase our operating margins. From a credit rating perspective, you'll all be aware that in September, Moody's downgraded the UK sovereign. And as a result of that, they immediately downgraded all of the housing associations that they review. As a result of that, we had a downgrade in our credit rating to Baa1 with a stable outlook. We have completed our annual assessment with S&P, and as a result of that, they reaffirmed our credit rating with A with a negative outlook. And then finally, from a regulatory perspective, the HCA completed their stability check a couple of weeks ago, and as a result of that, we've retained our G1V1 rating, which is the highest rating that they provide. Moving on to the group overview. So hopefully most of you will be familiar with the way that we structure the group. We have 2 distinct separate parts of the group, the regulated housing activities and the non-regulated housing activities. On the regulated side of the group, we have all of our housing associations, of which Place of People Homes is the largest. And as we've mentioned, Derwent joined us in December 2016. On the non-regulated side, we have our commercial businesses. So we have RMG and Touchstone, who are our management businesses. And then we've got Place of People Leisure, who manage leisure centres on behalf of local authorities. And those contracts tend to be long-term contracts, around 7 to 10 years. You can see as well, in terms of our lending structure, we make sure that there is no on-lending that goes between one side of the group to the other, that we have separate cash flows, and we have no guarantees between that straddle the two sides of the group. The borrower on the regulated side is Place People Treasury, and on the non-regulated side, it's Place People Finance. And as Matt said in the video, what we did this year was we made our first issuance on the non-regulated side through PFP Finance, and that was a £65 million retail bond in December. What I think that does is that demonstrates our ability to raise debt on that side of the group, and also to show that we are demonstrating that the funding is completely separate from the regulated side. On the regulated side, we've continued to diversify our investor base. So we completed an Australian dollar £150 million issuance in August, and then we followed that with a Hong Kong dollar issuance as well. We are committed to a 60% unsecured debt portfolio. We achieved that last year, as we reported, but as Derwent joined the group earlier on this year, they brought with them some secured debt. As a result of that, we moved to around about 51% of unsecured. So in order to readdress that, we did a recent tender and new issue where we tendered £154 million of an old secured bond and issued a new £250 million unsecured bond. And as a result of that, we've now got to 50% of our debt is now unsecured, with 42% secured, and we're going to continue to work on that until we exceed our threshold of 60%. What I would like to say is thank you very much for all of your support for those new issuances that we've done this year, and also a thank you to Matt Cooper, our Treasury Director, and his team for the work that they've done. Moving on now to look at the performance against our Treasury policies. We have minimum forward cash at the moment of 19 months against a target of 12 months. Our P&L interest cover is 1.83 times against a target of 1.2, and our gearing is currently at 56.7% against the target of 60%. So we're comfortably within all of our policies at the moment. We have a strong liquidity position, so at the moment we've got £632 million. And through the issuances that we've done over the past 18 months, our debt maturity profile now looks really healthy, with no significant debt that is due for repayment within the next few years. And that was all from me, so I'll now hand over to David.